Hello guys, welcome back to Channel for Trading. Today we are going to see income strategies in the weekend series all about options trading. If you are new to this channel and watching this video for the first time, I highly recommend watching the previous two videos for continuation. If you are a beginner, if you are already trading options, then from this episode onwards, you may start following. The strategies we are discussing from this episode is kind of intermediate to advanced level, except covered call, which is a basic strategy which we'll be discussing in the next slide. In this episode, I'll be covering three income strategies: covered call, bull put spread, bear call spread. From long iron butterfly onwards, I'll be explaining it in the episode 4, that is the next weekend series. What is income strategy? So basically, income strategies are typically deployed for short term, where collecting option premium is the main goal, ideally on monthly basis, and can be used for any time frame if you're familiar with basics of strategies. Considered 3% returns as very good income for deployed for a monthly basis, because if you compound to an annual rate, you will understand the reason. It will be a very good return. So first, let's understand what is covered call. As I said already, this is a basic of income strategies, but it is highly effective. Usually basic of something may not be highly effective, but in this covered call case, it is a basic income strategy but highly effective, and it is also used by beginner, also by advanced option traders. Here the concept is that if you own a stock, you then sell an OTM CE option on a monthly basis. Make sure you own the stock in numbers equal to lot size. Why this is important? Because if the stock starts a rally and closes above the strike price of the call option which you have sold, then you will be forced to exercise and the stock will be sold in lot sizes. If the CE option is sold in one lot size, you have to give stock delivery of one lot size. So the word of caution here is, if you own 100 shares of stock A, but the lot size of that stock A is 500, then this covered call will become super loss if you have to exercise the option contract. I hope you understand this concept. If not, please comment it down below. I will try to explain again in a different way based on your doubts. So here the covered call concept is, it is simple. You have to own the stock and you have to sell an OTM call option which is having a monthly expiry. The aim is to collect that premium which you are selling that CE for. So now let's see in which scenario we will make profit. Suppose the stock is not making any huge momentum for a month. The price of it is around the same region for a month. We call it sideways market. The CE option, what we sold, will become OTM at expiry, and the premium we will get it as profit. Also, if the stock has increased even little bit of price in the upward direction but not reach till the call strike price which we have sold, that way also it is profit for us. I hope these concepts are clear. Let's see the overview of covered call. What can be the strategy? As I said, buy stock, sell OTM call option, that is your covered call, and maximum risk, stock price paid minus the call option price. The maximum reward is, what is the strike price? What is the strike of call option you have chosen to sell minus stock price paid plus the call option price. The break even, stock price paid minus call option price. So when to deploy? So this is a neutral to bullish strategy. Select a stock accordingly with good immediate support so that it will not fall. Effect of time decay, that is basically a theta. In your favor, it will erode the value of call option sold provided the stock didn't hit the strike price at option expiry. And option Greeks also, I have given the explanation here. You can just go through it. I'm not explaining it in detail here again. That is about the option Greeks. And now let's see on the covered call a trading example. Okay, now consider stock A is trading for rupees 50 on December 28, 2020. What you have to do is, for a covered call, buy one lot size quantity of stock A at rupees 50. Sell one lot size quantity of Jan 31st, 2021 expiry for a strike price of 53 call option at rupees. This is just an example, okay? So may not be the price will be the actual, the call option may not be 2 rupees, but I'm just giving it an example. The strategy here is, we bought the stock, we are selling the OTM. So the 53 CE is your OTM call option. That becomes your covered call. The maximum risk, your stock price, which is 50 minus premium what you are selling for the call option of a OTM, that is 2 rupees. And maximum reward, the strike price which you have chosen minus the stock price plus the premium what you are receiving. And the break even is the stock price minus your CE premium what you are getting. I hope this is clear. If not, you can comment it down below. I'll explain it in a different way. So now what is the major advantage and disadvantage? If everything is good, then only this strategy is required, right? So there are advantages and disadvantages for every strategy. Let's see what are those. I'm not explaining every advantage and disadvantage. I've chosen the major advantage and disadvantage of this strategy. So the one advantage is it is good for generating monthly income on the stocks already bought. Okay, if it is not making a huge move, if it is going sideways, then also we are going to make good profit. Disadvantage is there is a capped upside. That means our profit is always capped. Profit we are going to get it, there is a limit on that. Because we are selling an option going above that strike price, it will be neutralized. And the disadvantage here is capped upside but uncapped downside risk. When the stock falls, we are only getting the fixed premium what we are selling for the call option, but the stock price is decreasing, so we will end up with loss ultimately. So that is where the break even will come into picture. So here in this example, the break even is if the stock falls to 48 rupees, we are in break even. We don't make any loss, we don't make any profit. But if it goes below 48, then this strategy doesn't hold good, it will end up in loss. So you have to deploy this strategy only when the stock is neutral to bullish. In that scenario, only this strategy you have to deploy for a stock. Now let's see the next one on the income strategies, which is bull put spread. So this is also an intermediate strategy which will be used in stocks which are sideways or in upward trend. You can see here also it's the same. In covered call also, this is a neutral to bullish stocks. We have to apply this strategy, and in this one also, bull put spread also, we have to use it in stocks which are sideways or in upward trend. Then you will ask, what is the difference? So covered call, we are buying the stock and then we have to deploy the option strategy every month. But bull put spread, we are not going to own any stock here. It is purely with the options we are going to deploy the strategy. You will understand how. So this is an intermediate strategy which will be used in stocks which are sideways or in upward trend. The concept here is sell OTM put option and buy OTM put option lesser than sell OTM PE. What it means is, if a stock is trading at around 50 rupees, if you are going to sell the OTM put option at 45, then you have to buy the OTM put option which is even lesser than your sold strike price. If you are choosing sell OTM PE as 45, then the buy OTM PE should be lesser than the 45. 45 here is the strike price of the sell OTM PE. So the strike price which we have to choose for buying OTM PE should be lesser than 45. Okay, and both the buy and the sell put option should have same expiry. That is called bull put spread. Now let's see the overview. The strategy I have already explained here, the net credit. Okay, so this is a net credit strategy, which means we are selling something, we are buying something, and if there is a difference in the sold premium versus the bought premium, so that difference is the credit or the profit for this strategy. Okay, and the maximum risk here is difference in strike selected. So we are selling a different put option and we are buying a different put option for strike price if we are concerned, right? So the difference in strike price, for example, sell OTM 45, buy OTM PE is 42, then the difference in strike price is 3 rupees. Okay, so the example is coming in the next slide. I'm not going to spend more time here on that. Let's see the other aspect. So difference in strike selected minus net credit. Then maximum reward is your net credit received, as I already told. And the break even, the higher strike. So the higher strike will be considering these two, right? The higher highest strike will be always your sell OTM put option. You cannot choose a higher sell strike price for buying, then this strategy doesn't hold good. So this will basically your sell OTM PE strike minus your net credit. When to deploy, this is a bullish or neutral to bullish view, and select stock accordingly with good immediate support. And the effect of time decay, that is your theta, in your favor, it will erode the value of PE sold, but this strategy also has buy position. So execute this strategy for short time periods only. When we say short time periods, it can be maximum of 1 month or less, not more than that. Okay, option Greeks, I have explained it here. The explanation you can see and the graph you can see here. We have explained this option Greek in the basic strategies. It's the same here also, so I'm not going to spend more time here. You can watch the other video to get an overview of what exactly each one are and how it is going to affect the option price. Now let's see the important part, trading an example. Consider stock A is trading at 2025 rupees on December 28, 2020. Then for bull put spread strategy, you have to buy one lot of Jan expiry, that is 1 month from now. The strike price selected is 1500 PE at rupees 37, and you have to sell one lot of the same expiry with a different strike price which is above this strike price, which I have selected here is 1875 PE at rupees 75. So now the table looks like this. You can see the net credit. It is difference in the premium what we have received and what we are paying, that is 38. The maximum risk is difference in strike price. The difference 1875 minus 1500, 375 minus the net credit what we received. That is the maximum risk here. All these calculations are based on single stock, right? But if you want to deploy this strategy, you have to minimum buy one lot size. So all these numbers you need to multiply into the lot size to get the actual figure. So your net credit will be, if the stock is having 500 as lot size, then the net credit will be 38 into 500. If your maximum risk also will be 337 into 500. Okay, this one you don't have to multiply into 500 because this is the strike or the price of the stock. If it comes as 1487, then you will be break even. So there is no need of multiplying this one, but other things you need to multiply with the lot size. Hope I am clear in this. Continuing with that, other major advantage and disadvantage. This is a short-term income strategy, as I already discussed, not requiring any major movement in stock, which is very important. If there is a movement in stock on the upward direction, but it is not very drastic, then also we will make money. But if it is heavy rally is coming, then on the upside, then this may not be the right strategy. The maximum loss is typically greater than maximum gain, despite the capped downside. Okay, so this maximum loss can be typically greater. You can see from this example also, the maximum risk we are seeing 337 into lot size, but the net credit is 38 into lot size. So it is clear, right? All the advantages and disadvantages are same for bear call spread also, and these two are also applicable for the bear call spread, and that we will be explaining in the next slide. So I think this strategy is also clear. If it is not clear, you can watch the video one more time, and if it is still having doubt, as I always say, please comment it down, I can explain it. So let's go into the last strategy in this episode, that is the bear call spread. So this is also an intermediate strategy which will be used in stocks that are either sideways or bearish. The concept here is sell OTM CE and buy OTM CE higher than sell OTM CE. Both buy and sell CE should have same expiry. Okay, now let's see the overview of bear call spread. The strategy which we have already discussed, buy far OTM call option and sell OTM call option, which will become your bear call spread. Net credit, the premium sold minus premium bought, which is same as bull put spread. The maximum risk is also the similar way, the difference in strike selected minus net credit. The reward is your net credit received, and your break even is lower strike, which will obviously be your sell OTM strike plus your net credit. Okay, so in the example, if you have to give, if a stock is trading at 50 rupees, then you are going to sell maybe 55 CE and you are going to buy 57 CE. This is just an example. The trading example will come later in the slide. So the break even will be lower strike among these two. That will obviously be your sell OTM CE price, will be your strike, okay, plus your net credit. So when to deploy, view is bearish or neutral to bearish. Select stock accordingly with good immediate resistance so that it will not go for a rally. Effect of time decay, which is in your favor, that is a theta. In your favor, it will erode the value of CE sold, but this strategy also has buy position. So execute this strategy for short time periods only, 1 month or less. Okay, and the option Greeks, you can see it is similar to the bull put spread, mirror image almost, you can see. I'm not going to explain this, the explanation is here. So let's see the trading example, which is really important. Consider a stock A is trading at rupees 2025 on December 28, 2020. Buy one lot of 2550 CE with an expiry of Jan 31st, 2021 at rupees 37. Then sell one lot of Jan 31st, 2021, which is same expiry as the buy of strike different 2175 CE at rupees 75. Then your table looks like this, which will be the net credit, your sold premium, that is your 75, minus your bought premium, that is 37, which will become 38 as net credit. Maximum risk, difference in strike price, which is 375, and you can see here minus the net credit will become 337, and maximum reward is the net credit, and break even will be 2175, which is your lower strike plus the net credit will become 2213. So the stock, if it moves till 2213, you will be in break even. If it is just below that, you will be in profit. If it is above that, you will be in loss. And major advantage and disadvantage, like we discussed in the previous slide, all the major advantages and disadvantages of bull put spread applies here also. Same way this applies for bull put spread also. Okay, so I have made it different so I don't have to repeat it again. So capped downside protection compared to a naked call, that is advantage. Then the disadvantage here is high yielding trades tend to mean less protective cushion and are considered riskier in the strategy, because the downside is not so safe. Okay, the reward is limited, your risk is unlimited. That way there is less cushion here, so that is one disadvantage for the strategy. The same way in bull put spread also. Okay, so that summarizes 3 income strategies for this episode. I think you will be able to follow this, and I'm going very slow also so that you can follow it in real time for the next week in your trading and see how this is working. So that is the reason I'm going very slow. So from next episode, I'll talk about long iron butterfly and remaining 2 more income strategies along with it. If you have any suggestion on the series of all about option trading, please let me know in the comment section below or update me in the Telegram channel. I hope you enjoyed. Thank you for watching. Have a nice day. Bye-bye.